Hello, my fellow investors, and welcome back to another video. Today, guys, we are going to continue this series that we started a few weeks ago, where every Monday we're going to take a look at each individual sector and pick out 3 companies that have pretty decent fundamentals. So far, we have done ETFs, the tech sector, the communications sector, the consumer staples sector, the healthcare sector, the financial sector, and today we are going to take a look at the consumer discretionary sector. And this sector is filled with a bunch of companies that people know, companies like Amazon, Tesla, McDonald's, etc. However, we're going to refrain from those big ones, guys, and we're going to take a look at a few that a lot of people don't really pay attention to. So with that said, make sure to like, subscribe, comment. It really does help here with the algorithm on YouTube as well as Rumble. And with that said, let's get started with the first company in the consumer cyclical sector. And that company is none other than Bookings Holdings. Now, right off the bat, this is something that I think a few people here have recommended. Never taken a look at it though, but it's a company that not a lot of people know of. So let's take a look at what they actually do. We can see here that Bookings Holdings Inc. provides travel and restaurant online reservations and related services worldwide. The company operates through bookings.com, which offers online accommodation reservations, rentalcars.com that provides online rental car reservation services, and Priceline, which offer online travel reservation services and consumer hotel, flight, and rental car reservation services, as well as vacation packages, cruises, and hotel distribution services. So their main thing, guys, has to do with, well, hotels, resorts, and cruise lines. So right off the bat, if you guys know, we're probably going to see terrible things when it comes to the 2020 year, which not really surprising. Nonetheless, though, even with that, on the 1 year, they are up 56.2%. Year to date so far, they're up almost 2%. And on the 5 year, which does include 2020, they're up a whopping 111.62%. On the 52-week range, this is near 52-week highs, as y'all can see over here, if not all-time highs, if I'm not mistaken, where it was at around $3,622.59 with a low of $2,289.69. Just as of last Friday, the 19th of January, this thing was up nearly 2.5% and post-market 0.2%. Now, looking at these fundamentals, the first thing that you'll notice is a massive drop as of 4 years ago on the net income, as well as the free cash flow and even the revenue. However, as I just said, guys, because their main thing has to do with hospitality, well, guess what? 4 years ago was 2020, so it doesn't really come as a surprise that you see a massive drop in each of these years for each of their profit metrics. So this to me isn't really a big deal. So you can see over here, if we look back at the net income, we can see that after 4 years ago, it actually steadied back up. It even surpassed the 5 year ago value as of 1 year ago, 2023. The same thing can be said when it comes to the free cash flow as well as the revenue. So even though we see a massive drop, there really isn't that big of a deal in my personal opinion. Now, when it comes to the assets and liabilities, this is where alarms start to come off. And that is the fact that as of 1 year ago, we see this thing go into the negative. This is mainly because they packed on liabilities, not because of the fact that they're losing assets. So the question here is, where's those liabilities going? That's why, even though it's in the negative when it comes to the assets minus the liabilities, I don't see this as a terrible thing, because you would have to do more research as to where these liabilities are actually going into. And next, when you see the cash flow minus the total liabilities, we can see that, yes, it is downtrending. However, it's okay, I guess you could say, because at the end of the day, their cash flow is increasing at a great rate. But at the same time, it goes back to the question of, where are those liabilities going? And lastly, when taking a look at the shares outstanding, this looks absolutely incredible. They had 1 year where they actually increased shares, and that was from 3 years ago to 2 years ago, but it was barely an increase of shares. Nonetheless, though, going from 45.6 million shares to 35.2, that's an insane amount of buyback. So really, really great to see. So with all of that, we can see that this company is something that we may want to buy into. Obviously, we're not going to do a discounted free cash flow approach. We'll probably do that at a later point. Nonetheless, though, it is something that you guys can take a look at for yourselves. So with that said, now let's go into the second company in this sector, and that would be the company Tractor Supply. Now, straight up, this one, it's out of left field because I knew about this one. However, I didn't know that their fundamentals were this good. The cash flow minus the liabilities could be a little bit better, but honestly, for what they've been through, it may be at a good valuation at this point, assuming that they continue to go the way that they're going right now. It may be a company that perhaps may be undervalued, and we actually may cover it when they do have earnings on February 1st. So let's take a look at some of this. Looking at this company on the 1 year, we can see that they're up 11.7%. Year to date, they're up 7.45%. On the 5 year, even through COVID though, they're up a whopping 158.57%. They're not at all-time highs or even 52-week highs, but they are leaning towards that, where it was around $251.17 with a low of $185 on the dot. If we take a look at what they did on Friday, January 19th, we can see that they're up 0.35%, and post-market, they're down 0.12%. Now, they do pay out a dividend of 1.78% yield with an annual payout of $4.12, a payout ratio of 39.16, a whopping 5-year CAGR of almost 28%, which is insane, and 12 consecutive years of dividend payment. Ex-dividend date passed as of November 24th. Payout date was on the 12th of December, and they pay their dividends quarterly. Most likely, their next ex-dividend date will be on around February 24th. Now, if we take a look at these fundamentals, starting off, the net income is looking absolutely gorgeous. The free cash flow is the one that puts up some alarm bells, where 4 years ago during COVID, you could see a massive spike, and then they came down as of 3 years ago. However, you could attribute this once again to COVID. Probably people were out and about buying a lot of stuff back when, COVID was happening. And then the following year, things died down a little bit. But as of then, you guys can see that they are recovering nicely, picking up even further than that of the 5-year ago value, where it was at around $594 million. So they surpassed that as of 2023. And if you do take COVID as an outlier year, then it is what it is. You guys can see that this is a nice uptrend. The revenue is incredible as well, similar to that of the net income, as you guys can see, nice consistently increasing upwards. The assets minus liabilities looking also the same, really nice increase. And the cash flow minus liabilities, as I said, it is consistently decreasing. However, just like bookings, you have to now question where are these liabilities actually going to? Because if they're going to something good that can actually benefit them, then, the cash flow minus liabilities coming down, it's not really that big of a deal. And lastly, the shares outstanding. This looks absolutely incredible. Consistent buyback on the past 5 years, going from 118.2 million shares to today of 108.5 million shares. So all in all, Tractor Supply is actually the company that maybe is not one that you guys should sleep on. It's a company that isn't heard about a lot, and those companies may be the ones that have a great valuation right now. Again, we haven't done a discounted free cash flow, but this is going to be one I put on the list for when we live stream on their earnings on February 1st. So with that said, let's move now into the last company in this sector, and that is the company's Chipotle. So this is one that I have done here on the channel, but I think I've only ever done it one time. And man, to my surprise, I was not expecting these fundamentals when I first saw it. But yeah, it's an insane company. So looking at this company on the 1 year, we can see that they're up 55.21%. On the year to date, they're up 2.08%. On the 5 year, this is the big one, 350% on the 5 year. Absolutely insanity. Near 52-week highs, if not all-time highs, as you guys can see right here at $2,348.42 and a low of $1,470. As of Friday alone, January 19th, they did around 0.5%, and post-market, they did 0.06%. So looking at these fundamentals, we could see that this is kind of crazy. Starting, of course, with the net income, we can see that pretty consistently increasing. In fact, as of 4 to 3 years ago, that's a massive spike, which is not really surprising since, remember, 4 years ago was COVID, and even during COVID, they did go up in their net income by like $5 million. But going after COVID, people had a lot more money in their bank accounts, which explains their massive rise from 4 years ago to 3 years ago. And if we take a look at the free cash, we kind of see a little bit of the opposite. 5 to 4 years ago, we do see a little bit of a downturn, but that's just COVID explainable. And then a massive spike from 4 to 3 years ago, and then a little bit of a rise from 3 to 2 years ago, and then a massive spike from 2 to 1 year ago, 2023. So the free cash flow is looking really, really good as well. COVID year, you can pretty much just take it as an outlier. And the revenue, this is very consistently increasing. This almost looks perfect, where the trend line and those graphs hit every single time. Looking at the assets minus liabilities, it looks really, really good too. Nice, consistently increasing. Cash flow minus liabilities, you guys could see that as of 4 years ago to 1 year ago, it's pretty stable at around like the negative $3.6 billion mark, which is not something I like to see, but stability is okay in my book. And lastly, for the shares outstanding, once again, it is pretty consistent. It is a slight decrease going from 27.8 million to 27.5 million, but you can see that they do increase it when necessary. So all in all, when it comes to Chipotle, yeah, it's a company that I really would like to cover again. I believe their earnings is on February 6th, so I would like to cover them. I really would, because at the current price tag of $2,000+, this might be one that is a little bit expensive, but then again, we need to see what the discounted free cash flow says. So that pretty much does it, guys, for 3 companies in the consumer cyclical sector. Really interesting sector. It has a lot of companies here that I do like. A couple other ones that, for example, we didn't cover, like Domino's Pizza, DPZ, and obviously the big ones like Lowe's, Home Depot, that kind of stuff. But I figured these 3 ones are ones that people don't really take a look at. And even though CMG is a major restaurant, I rarely see people talk about it. So that's the reason why I included it. Anyways, that pretty much does it for this video. Make sure to like, subscribe, comment. Really does help here with the algorithm on YouTube as well as Rumble. Make sure to follow us on X for daily posts. And with that said, peace out, and we'll see you all on the live streams this upcoming week, 7 p.m. Eastern. Peace out.